Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada podcast. Today's episode is going to be especially useful if you're a Canadian DIY investor and you want to build an optimized, passive, low-cost portfolio, but you still have some questions about some of the practical details. For example, should you just buy one all-in-one asset allocation ETF, or is there a benefit to buying the underlying ETFs individually? How much should you care about ETF trading volume? What does liquidity actually mean when we're talking about ETFs? And should you use market orders or limit orders when you're buying your ETFs? And if you're an income-focused investor, what are the pros and cons of building your portfolio around dividends? We also get into the active versus passive investing debate, why it's so difficult for stock pickers and active managers to consistently beat the market over the long term, and how investors can think about risk when comparing traditional bonds with things like low volatility ETFs. To help answer these questions, we have two great guests joining us today. First, we have Chris White from Canadian Money Saver magazine. Chris is also the head of research at 5i Research, and you may have heard him on CBC Radio or BNN Bloomberg. We're also joined by popular returning guest Danielle Nezel, who is a very experienced and passionate educator when it comes to DIY investing here in Canada, especially index investing using low-cost ETFs, which, by the way, is literally how I invest all my money. Danielle is one of the hosts of the ETF Market Insights YouTube channel. She's a frequent speaker at industry events across Canada, and she works at BMO ETFs, one of the largest ETF providers in Canada. So she has incredible access to some of the best education, best practices, and resources when it comes to DIY investing in Canada. Also, as a Build with Canada listener, we actually have a brand new free issue of Canadian Money Saver magazine available for you thanks to our guests. The issue focuses specifically on ETFs here in Canada. I wrote an article for it as well, and you can get the digital version of the entire magazine for free by going to buildwealthcanada.ca/magazine. That's buildwealthcanada.ca/magazine. It's completely free, and a big thank you to our guests for making this issue available for free to all Build Wealth Canada listeners. With that said, let's get into the interview with Chris White and Danielle Nezel. All right, Danielle and Chris, welcome to the show.
So great to be here. Thanks, Cornell.
Thanks, Cornell. Thanks for having me.
Awesome. Great to have you on board and pick both of your brains regarding best practices, especially when it comes to ETFs. So, Danielle, let's start with the fundamental debate in the investing world. Time and time again, the data shows that active stock pickers struggle to beat the market over the long term, especially once fees are factored in. You wrote an entire article about this in the magazine. For those listeners who might be tempted to hunt for the next big winning stock, why is it so notoriously difficult for active managers and individual stock pickers to consistently win?
Right. It's a great question. We talk about it a lot, but maybe first I'll just define for those that don't know the difference between an active manager and maybe a passive investor. An active manager is making active bets on the stock market. They're picking a few stocks, usually a concentrated portfolio, making big bets on specific companies that they think will beat out broad market returns. The other side of the coin is the person investing in broad market returns, and we call this usually passive investing or index investing. And that's someone who says, hey, I'm just going to buy all the stocks in a specific market, and I'll just take that broad market return every year. Now, in the article I wrote in the upcoming CMS issue, it was about ETFs versus stocks. And if you're a retail investor or direct investor who are picking stocks, you're kind of taking on that role of an active portfolio manager. Now, when we look at the data, and specifically we look at these reports, they're called SPIVA reports, so S&P Index versus Active Managers. And you can find these online. SPIVA publishes these reports twice a year. They look at the data of active managers who are professional active managers managing usually active mutual funds or active investment funds. And they look at their returns over a series of years for a historical period. And what we find is that over longer periods, active managers consistently underperform the index. And this happens more frequently as our time period gets longer and longer. So if you are a long-term investor, based on these reports and based on the data, the historical data we have, you might be better off in a total index fund. It's very hard to outperform that index. And you also have to remember too, as a retail investor, you don't have the tools at your fingertips that an professional active manager does. They have tons of education in portfolio management. They have a lot of resources within their office spaces. They have teams of analysts looking at, trying to pick the best stocks. And quite frequently, they continue to underperform total market return. So that data is powerful when talking about ETF investing, which a lot of ETF investing is index investing versus stock picking. And then you have to ask yourself the question, well, why do these professional active managers, how come they consistently underperform the stock market, especially when you look at long-term data? And a lot of that is because, markets are really, really efficient. The price of a stock is priced with all the publicly known data that we have. So it's very, very hard to find, a small nugget of information that might suggest that stock could be, undervalued or overvalued. So, again, this is something that's really difficult for a retail investor to achieve. So thinking about stocks in a portfolio versus, total market index approach using an ETF is something an investor really should consider, and then use those SPIVA reports to back up that data.
And Danielle, let's transition to the actual mechanics of buying and selling, specifically regarding liquidity. To set the stage for our newer DIY investors, how do you define liquidity, and how does liquidity work differently for an ETF compared to an individual stock?
Sure. And we actually did cover this in the CMS issue as well. We talked about ETF liquidity because we get so many questions from direct investors and retail investors about ETF liquidity, and there are a lot of misconceptions out there. So, if you ask what's liquidity, really it's the ease and the quickness that you can turn your investment into cash. And an example I like to use of an illiquid investment, or something that's not liquid, if you are a homeowner or you own real estate, like your house or your real estate is not a liquid investment. If you decided you needed to turn that investment into cash, that would be kind of an arduous process. You have to list it. You need a listing agent. There are a lot of transaction fees involved. And the amount of cash or the cost you'll end up getting once you sell, or if you sell, it's not predictable. So on the contrary to that would be a stock investment or an ETF investment, something trading on the exchange. These are generally very highly liquid investments, meaning that, if you are a direct investor and you have an online brokerage account, you can easily go online, sell an ETF or sell a stock, and you'll have your cash when the trade settles. I think it's T1 or T2 is the settle process. So within 48 hours, you have your cash. So this big benefit for us, anybody who needs liquidity, is using things like ETFs or stocks to gain that liquidity. Now, with an ETF, there's 3 layers of liquidity, and this is a little bit different from stocks. And this is where investors get confused. So I get a lot of questions from direct investors saying, I'm looking at this BMO ETF and the volume is looking kind of low, and I'm worried, well, if I need to sell it, is there liquidity there? And the answer is yes, there is lots of liquidity. And when you look up volume of an ETF, it doesn't tell you the entire picture of that ETF's liquidity. And this is why the largest ETFs in Canada, so those with over $1 billion in assets, they will have very high trading volume because those ETFs are very mature and they typically trade between buyer and seller frequently throughout the day. But ETFs that have smaller asset bases might not trade as frequently. But here's the thing, they might hold stocks, or they probably generally do hold stocks within their basket that are highly liquid stocks. And an ETF is an open-ended investment. So what that means is we can build an ETF to support demand or to support supply, depending on, what's tipping the scales. Our team and our teams of market makers that we work with can go out and buy all the stocks in that ETF and deliver that ETF to an investor. Or alternatively, if the investor is trying to cash out, we'll take the ETF and sell all the stocks in the market and give that cash back to that investor. So this process, we call it the creation redemption process. This creates this really deep layer of liquidity for ETFs that investors generally don't see.
Gotcha. Because I assume with a company, they have a finite amount of stocks that they've issued, that they've agreed to issue. And so if somebody wants to purchase more, they're kind of limited by that finite number. And I guess the company could always issue more stock. But then that's, I imagine, a much bigger, more involved, more difficult process than it would be for an ETF provider. Is that fair to say, Danielle?
Exactly. Now, if you're holding, a more esoteric ETF that maybe it invests in small cap companies, or maybe it's investing in overseas markets, those ETFs could be a little less liquid because, again, the underlying stocks would be less liquid. But if you're looking at an ETF that's holding large cap, blue chip stocks, especially if they're trading on the North American markets, there will be highly liquid ETFs, even if the trading volume of that ETF looks low.
Gotcha. And we're going to get into the bid-ask spread in a second with Chris, but is that the reason why the bid-ask spread is so low for ETFs, because they are so liquid?
Correct. So the bid-ask spread it gives you an indication of how liquid that ETF is. And, if you're looking at ETFs that maybe are holding foreign stocks where the markets are closed when a North American trader is trading, those ETFs could have a little bit wider bid-ask spreads, or other asset classes like preferred shares or certain fixed income could have wider bid-ask spreads. But again, most ETFs are very, very liquid. And in fact, when we're talking about things like fixed income, ETFs actually bring more liquidity to an asset class like fixed income where, Cornell, Chris, we can't just go out and buy bonds. That's a hard thing to do. They trade over the counter and the markets are more opaque. But you can easily, and you can certainly buy a fixed income ETF in your direct brokerage account.
Awesome. So Chris, let's switch things over to you. Let's talk about the bid-ask spread. Could you break down exactly what it is and what do we need to know about it as DIY investors?
Yeah, for sure. Yeah. And I'm glad that Danielle also brought up like a house analogy there, because I'm going to be using one as well. Really, the easiest way to think about the bid-ask spread is by using a house analogy. So when an individual is looking at purchasing a house, so the ask can be thought of as the price, or the price that the seller wants, and the bid is the price that the buyer is willing to pay. And then the spread is really just the difference between those two numbers. So in ETFs, it works the exact same way. An ETF has, let's say, a $10 bid. So that's $10 on the dot. And then it might have a $10.02 ask. So trades can happen anywhere in between, depending on where buyers and sellers meet. So yeah, for most retail investors, one of the key takeaways is not really just buying simply at the ask price, because that's where order is almost likely to just be executed immediately. But instead, an investor can offer somewhere in the middle of that spread. Investors can look at the bid price, the ask price, and then where the ETF is trading at that point in time. And that is usually somewhere in the middle of the spread. But there is some nuance here. So in a high market moving day where, let's say, the market's moving up significantly, usually the ETF can trade closer to the upper end of that bid-ask spread. And so that's where there's some nuance in how to place an order. And I think we'll get to some of that point later on. But yeah, essentially in very liquid ETFs, the spread is usually really tiny. And we talked about there's so many different angles of what liquidity in an ETF means. But really, investors can see that in liquid ETFs, that spread is usually just a penny or two. But in less liquid ETFs, it can be wider. So this is where it's really worth paying attention to.
And now a quick message from one of our sponsors. We spent years and eventually decades optimizing our portfolios, maximizing our RRSPs and TFSAs, and fighting for every fee and tax deduction that we can find to help us reach financial independence faster. But we often overlook the one vulnerability that can jeopardize all that hard work in an instant: online security. I have been using Talos Online Security to keep my and my family's data and devices safe at home and on the go, and now I can stress less about sketchy links, phishing emails, and hidden data breaches. My favorite part is that it is a comprehensive, all-in-one suite of tools. I used to juggle multiple companies for my online protection, whether it was antivirus, VPN, dark web, and credit monitoring, just to name a few, but I still wasn't sure if I actually had all my bases covered. These days, I just use Talos Online Security. It covers all my bases in a single intuitive product, and it makes managing our online security so much easier. It's also much more cost effective than dealing with multiple different companies that each tackle only a small portion of your online security. The plans start at just $12 per month, and you can see the plan that I use over at buildwealthcanada.ca/Telus. That's buildwealthcanada.ca/Telus. And then Danielle and Chris, when we are ready to hit that buy button inside of our brokerage accounts, we are faced with choosing an order type as well. Can you explain the mechanics of a market order versus a limit order? And what are your recommended best practices when it comes to executing ETF trades?
Well, one of the ETF best practices that we talk to investors about is when they're making a trade to consider using a limit order instead of a market order when they're placing that ETF trade. So a market order is when you're placing a trade, it's going to take the current market price of that ETF or that stock and execute the trade on that price. But what you're exposing yourself to is a little bit of price movement risk. And, on a trading day that might be boring trading day, there's not a lot of headlines. This would be okay. There's probably not a lot of risk. But the risk comes when if there is a headline, something happens geopolitically, President Trump makes a post or says something, which we've been seeing more lately, something provocative, it shakes the markets. That can really impact a heavy price swing of the stock or the ETF that you are about to trade. And it's something you're not expecting and you're not realizing it's going to happen. And all of a sudden you click execute and that ETF or stock could trade for a price way off what you thought you were going to buy or sell it for. And so we tell investors to use limit orders. And this is where you take a price, you set a price, and Chris made a great suggestion. Hey, just maybe take a price that's right in the middle of that bid-ask spread, and your trade will only execute when the stock or the ETF hits that price, that limit that you have set. And there, you're kind of just protecting yourself of severe price swings, which again, don't happen often, but they do happen sometimes. So, why take the risk? Set that limit order and then you're protected. The other ETF best practice we talk about frequently is try not to buy or sell your ETFs at the first 30 minutes of market trading and the last 30 minutes of market trading. These are very busy trading moments because the markets are either digesting things that happen overnight or people are trying to get trades in right before market closes. And so we tend to find the biggest price swings in, stocks or ETFs happen the first 30 minutes or the last 30 minutes of the day, of the trading day. So make sure, again, when you're placing that ETF trade, maybe avoid those times in the market.
And then, Chris, is there any best practices on your end that you like to employ?
Yeah, for sure. So not too much to add to what Daniel was saying there. Typically for me, if the spread is really wide, I usually just use a limit order and then focusing on somewhere in the middle, or depending on the time of day or the market liquidity and just how the market's moving that day, it might change to the upper bound or the lower bound. Usually when an ETF has a really tight spread and it's just a couple pennies or fractions, I just usually submit a market order personally, because the cost of getting into the market, that's where I place a lot of emphasis, is just getting into the market, because I'm not going to pretend that I know where the market's going to move in the next 10 to 15 minutes or so. So I just usually place in a market order, and then the spread is so tight that usually it shouldn't move against an investor too much. And with depending on if the market's moving a lot and it's moving up and an investor has a limit order in, and say they put their order in right in the middle of the spread, there is a potential for investors to be forced to basically chase higher. So if the market's moving up, they have their limit right in the middle. The spreads, like the bid-ask spread, might just keep moving up. Like it's a moving target and it'll move up against an investor. And so that's where it's worth looking at that upper bound of the bid-ask spread and just assessing, was it worth just getting into the market before it moves fully against me? And then I'm priced out, basically.
Awesome. Thank you. Danielle, one of the most common dilemmas DIY investors face today is choosing their portfolio structure. On the one hand, you have the simplicity of a single asset allocation ETF, the all-in-one portfolio. And on the other hand, you can purchase the underlying ETFs individually. For someone completely new to this, can you first explain what these two methods actually are?
Right. So asset allocation ETFs came to market here in Canada a little over 5 years ago, and they've been wildly popular. Investors love them, and they love them for several different reasons. One of them is their simplicity. So you can own one ETF in your investment account, and it holds the underlying probably 7 or 8 different ETFs. And so therefore you're globally invested in equities and fixed income and varying weights of equities and fixed income. But you have just one trade to make and you don't have to think about it anymore. And it's a total market index approach to investing. And they're very low fee products. The lowest fee ones in Canada are 15 basis points management fee. BMO's asset allocation ETFs are priced at that. Some of them are a little bit more, but generally ranging between 15 and 20 basis points. Okay, this is a very, very low fee when we look at the average weight of an ETF in Canada, which is still low relative to other funds or other investments, is around 37 basis points. So investors just love the simplicity, the ease of use. They're rebalanced, so they're diversified and they're always in check. All their balances, and keeps their risk dialed down as well with all that diversification. So that's the asset allocation approach to investing. When we talk about using different ETFs as building blocks, this is making a more tailored portfolio to satisfy your unique investor profile. So where we see a lot of investors doing this is investors might have high conviction on a specific area of the market, like a sector or a region. So they choose to use an ETF to pinpoint that high conviction area, and they'll add that to a portfolio. Some investors are income investors, so they choose to add some dividend ETFs or covered call ETFs, something with an enhanced income. And then they can add broad market ETFs as well and really just tailor a portfolio for them that suits their needs. Where these investors, I will tell them, if you are using ETFs, great, you're already diversified, so that helps keep your risk in check. But you still need to know where those balances are. If you're using a sector ETF, let's say it's a growth sector, you could be really overweight right now in your portfolio. If you've held that for a few years and it's had really strong performance, you might think, okay, maybe I need to trim this position back to keep my overall risk profile in line. But that's the ease and the beauty of ETFs is investors can choose which way they want to invest, whether it's the asset allocation approach or using several different ETFs as building blocks. And then they can pinpoint the exact area of the market that they want to invest in. So 2 different approaches, one definitely a little more active, the other really just kind of a set it and forget it approach.
Chris, in your experience, what are some of the reasons that an investor may choose to buy multiple different ETFs instead of just keeping it simple with a single all-in-one asset allocation ETF? Danielle mentioned a few of those examples, but are there any that come to mind for you in particular?
Yeah, for sure. Yeah, all-in-one ETFs are really a great product, and it's fantastic because they provide that instant diversification across stocks and bonds, all into one single kind of package product. And for many investors, this can really just be a complete portfolio. It's simplicity, a bit of peace of mind. They can just look at their portfolio and just see one ETF, and that's the entirety of their portfolio, and it's all managed right there. But there are some investors that still prefer owning multiple ETFs, and there's a variety of reasons for that. The first is customization. So all-in-one ETFs typically have some sort of a fixed mix of assets. So for example, some might have a 60% stocks and 40% bonds allocation. So the classic 60-40, and that might not be perfectly aligned with every investor's preference. So by using multiple ETFs, investors can fine-tune those things like how much equity exposure they have or their bond exposure or perhaps geographic allocation, because some of these all-in-one ETFs do tactically tilt between geographies. So investors can really tailor their entire portfolio by using individual ETFs to really target some of those different areas. And then, as Danielle mentioned, on the second point is tactical tilt. So if investors have really high conviction in an area that they feel they have an expertise in or good knowledge, working knowledge in, let's say it's semiconductors and an investor wants to tilt towards semiconductors, they can buy a semiconductor ETF and just tilt towards that direction. And then on the final point, some investors also like the structural diversification that owning multiple different ETFs provides. They could have ETFs from different issuers or in different currencies, and that can provide just a little bit of extra flexibility and that peace of mind. If an investor has ETFs in both USD and Canadian dollars, if the US dollar just moves materially higher against the Canadian dollar, that can allow an investor to rebalance or to just you target towards USD. So just that flexibility that it offers for most investors, while the all-in-one ETFs are really convenient, using multiple ETFs can really give investors a little bit more control over how their portfolio is built.
Great. And then Chris, for investors that would rather purchase individual ETFs instead of a single all-in-one ETF, what are some of the portfolio maintenance best practices that they should do on an ongoing basis? Like the things you mentioned obviously give you a lot more flexibility, but it also, I mean, it's a lot more work, right? To make sure that as everything moves up and down, to make sure that everything is still the way you initially intended. Can you give us some of these best practices that you think people should definitely keep an eye on?
Yeah, definitely. Yeah, there's a few maintenance habits that investors can keep an eye on things and just assess how their portfolio is moving for those that are, using multiple ETFs. So the first point is on periodic rebalancing. So over time, if an investor has multiple different ETFs in different targeted weights and different asset classes, some of those ETFs will outperform others. And so it's important for investors to check in every so often. And the cadence of that could be monthly, quarterly, semi-annually, just to assess where the weights have gone and where they initially started. And if an investor has like a target weight, then they can sell some of the outperformers, and then rebalance back into some of those names that have maybe been lagging. And on that point, like a stock that's lagging or an ETF that's lagging might not just be lagging for a structural reason. It could just be market-based. And so that's why rebalancing really helps, because the market's so cyclical in every area of it and every sector. That's why rebalancing can really work in an investor's best favor. And then on the second point, it's the monitoring costs. So ETF expense ratios can fall over time as competition begins to increase. And this is why it's worth occasionally checking in on if a similar ETF exists somewhere else at a lower cost and just monitoring those costs. Although within a certain basis point range, it's not always worth to switch. But if there is a wider gap, that's when it might be worth looking outside. And then the third point is just keeping an eye on liquidity and trading spreads. So as we mentioned, there's many facets to liquidity for smaller ETFs that have less liquid holdings. If that ETF starts to see its spreads widen, it might be worth reassessing if it's the best vehicle for that exposure.
You mentioned rebalancing. There's different schools of thought on when one should rebalance. Do you have any favorites, like whether it's for your own portfolio, that you tend to subscribe to in terms of when you personally like to rebalance your portfolio?
Yeah, definitely. So I think we like to look at specific weights, and we target like a mental threshold that investors can sleep well at night with. So each individual investor is unique and they have their own risk tolerance levels and so on and so forth. But if an investor sets a specific percentage that they're comfortable with, if an ETF gets to, let's say it's 10 to 15 or 20% of their portfolio, they might say, okay, any percent above that, and I'm going to trim it back, and then I'm going to rebalance into the other ETFs that have maybe come down in weighting. And could be when it goes above that target weight by 1%, 2%, 3%. But essentially, investors really need to just think about it, take some time to think about it and see if it got to go through some mental math and just say, okay, if it got to 20%, would I be comfortable sleeping at night with that? And if not, then it's worth just keeping that as the target weight for a certain ETF or component of their portfolio, and then just trimming it back every time it hits that weight.
Awesome. Yeah, and if any of this sounds confusing and a lot of work, the very nice alternative is just to get an asset allocation ETF, and then you don't have to worry about, basically with those, if you're investing a certain percentage of your income every month, you just use that to buy that asset allocation ETF. It's going to automatically rebalance for you, so you don't need to do that. So all you have to remember is pretty much to invest a portion of your paycheck so that you're continuously investing. And then also when those asset allocation ETFs issue dividends and interest as well, if you have bonds in it, then to reinvest those as well. But I noticed even with some of the brokerages now, they have certain tools set up where those can be automated now too, where those will automatically reinvest for you too. So yeah, so that definitely kind of different flavors for different people depending how hands-on you want to get. But I would say, at least from all the listeners I've talked to over the years, I've definitely kind of moved over, even though I do a lot of underlying ETFs just because I've been at this for a long time. And I started doing this even before these asset allocation ETFs became so major here in Canada, I would say, like when I'm teaching my kids, for example, I'm going to say, okay, start with the allocation ETFs. And not even just kids, but my parents as well, because not everybody wants to go through all these exercises of this ongoing maintenance, right? It's just one more thing you now have to do and you have to manage and watch very closely, right? Chris, let's shift gears to a strategy that is incredibly popular here in Canada, dividend and income-focused investing. A lot of investors love that psychological comfort of semi-reliable dividends, especially because it means they don't have to sell shares at a loss during market downturns. What are the pros and cons of this purely income-focused approach?
Yeah, definitely. So dividend and income investing, like you said, is incredibly popular in Canada. And a big reason for that is exactly what you mentioned. It's that psychological comfort aspect. So when markets are volatile or they're falling, investors can still see those cash distributions coming into their account, which really helps certain investors to stay invested. Just that mental kind of component to it. And then on the pro side, dividend paying companies often tend to be fairly established businesses with strong free cash flows. And if a company is consistently paying and growing its dividend, that usually means that it has some sort of profitable and stable business model. And the management team is most likely incentivized to keep expenses low, keep their operational efficiencies high so that they continue to generate free cash flow to service those dividends. And a lot of these dividend paying companies, these are usually companies that investors buy mostly because they are dividend stocks. And so it's in the management's best interest that they don't lose that kind of status as a dividend paying company. Like as soon as they cut the dividend or suspend it, it could lose a lot of faith could be lost, but then investors might seek another name elsewhere and that holder base deteriorates. So really, dividend paying stocks are great for that because management is incentivized to keep those expenses low and keep the business lean. Another benefit is flexibility. When investors receive distributions from an ETF, that cash can be used for anything like income, discretionary spending outside of the portfolio. This could be even for retirement purposes, or an investor can use that and reinvest it back into the market. And the cash distribution could be used for repurchasing that ETF that it came from, or it could be into DCAing or dollar cost averaging into a new ETF or some other area of the market. So it's really the optionality that distributions bring that is really so beneficial about dividend and income investing. And then on the con side, I think one of the biggest risks is really chasing yield. So I think sometimes investors can focus too much on the dividend percentage and not so much on the underlying business. So when investors look at just very high yields, a lot of the underlying stocks in that ETF, if it's a really high yield ETF, some of those stocks that pay really high yields, it really could just be a warning sign that the market's worried that maybe the company's not able to service its dividend anymore. The business might be deteriorating, which could mean it's not sustainable. So high yield is actually sometimes a red flag. So really not so much focusing on chasing yield, but looking at a solid dividend yield or distribution yield, and then looking at the underlying stocks and making sure that they're also dividend growers as well, which is important. And then this isn't really so much a con, but I think it's an area that investors should be at least cognizant of, or at least a little bit careful, is around covered call ETFs that have a leverage component, especially. There are certain covered call ETFs which have some sort of moderate leverage component, it might be 25 to 50%, and they can generate really high income, but there's also, the capped upside component to it and strong markets. But also, I just feel that these leverage versions haven't really been battle tested through a really severe market drawdown yet. So they've come into play over the last several years, but we haven't really seen what that leverage looks like in a really bad market. And I just think whenever there's leverage involved, bad things can happen. So that's one area I just look at. So yeah, overall, dividend investing can be an effective strategy for sure. And just like any approach, it works best when investors focus on quality and sustainability.
Danielle, if a Canadian investor decides that this is the right path for them, they want to do a more income-focused approach, what are some of the options available to them in the Canadian marketplace?
Right. Well, there's an ETF for that. Isn't that great, Cornell? There's an ETF for everything. So what we've seen at BMO, again, a lot of Canadians, they do really like their dividend companies. And the Canadian market is more heavily weighted to dividend companies versus something like the US market, which right now represents a little more of a growth market. And as Chris talked about, dividend companies usually are more mature companies who probably have less areas to grow. And so they do pay out some of that cash to investors. And so again, it's really important to understand those companies and make sure that those companies can consistently and persistently pay out those dividends over time and are sustainable. So we have a few different dividend ETFs at BMO, and we organize them by region. So an investor, for example, that wants to buy Canadian dividend-paying companies can buy something like ZDV, which is the BMO Canadian Dividend ETF. And ZDV, what we do is we look at the entire Canadian stock market and we pull out the highest dividend paying companies. But as Chris alluded to, we're making sure we're not looking just at yield. We're looking at 5-year history of that dividend. We're looking at cash flow, operating cash flows on balance sheet to make sure that those dividends are not only sustainable, but are growing as well. So again, as an investor, you're doing your due diligence, look into the methodologies of the dividend ETF that you're investing in, because it's very important. You know, in the pandemic, especially as an example, we saw a lot of dividend paying companies stop paying dividends. An example, though, of a high quality dividend payer is one of the big 6 banks here in Canada. I work at one, but we haven't cut a dividend at BMO. I think it's like 200 years or since we started. So looking at those companies with the sustainable dividends and cash flow is important. Chris, you also talked about enhanced income products or covered call products. This is a whole nother world of income because you're getting option premiums generally from those covered calls as part of that ETF distribution. At BMO, we do have high dividend covered call ETFs. So we use a similar approach to ZDV. We pick out high dividend companies that are sustainable, high quality, and we then layer on an option overlay component. So then an investor gets that dividend income plus the option premium, which investors really like. And dividend income is taxed more preferably, especially from Canadian companies here in Canada, as a general note. So that can be a more tax efficient distribution than something from a fixed income product. So again, look at the type of covered call ETF you're investing in because there could be other things at play. Covered call strategies vary. There could be leverage. There's a whole bunch of due diligence questions you need to ask yourself. And lastly, I will say that a lot of investors are attracted to income products right now because they like that, Cornell, you said that psychological component where I'm seeing cash come into my account every month and it feels like good, like an extra paycheck. But what you're trading off for that income is growth. And if you're an investor who has a long time horizon, if you're younger, if you don't need, money to fund retirement, you might think about, well, do I need that cash flow? Because what I'm kind of giving up is future growth. And that's something to really consider as you go down the path of if you want more enhanced income product or dividend or growth ETF.
And now a quick message from one of our sponsors. There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor. And you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights or visit etfmarketinsights.com so you can be notified when future episodes go live. And now back to the show. In the magazine, there was also a Q&A section. And one of the interesting questions from a reader was, should I replace my bonds with a low volatility ETF? This is an interesting dilemma for someone that's trying to manage risk while potentially chasing higher returns at the same time. Chris, let's start with you. What is your take on this? And what are the pros and cons of substituting traditional fixed income with low volatility equity ETFs?
Yeah, for sure. It's a great question. And it really depends on the investor's risk tolerance levels and their ability to take risks. So I would say for investors who are comfortable being mostly or almost entirely in equities, adding in a low volatility ETF or multiple of them can sometimes act as a mental substitute for bonds. These are ETFs which tend to hold more defensive companies, things like utilities or consumer staples, which historically have had smaller drawdowns and often pay fairly steady dividends. On a structural level, they are still equities, and that's the key differentiator here. The importance of bonds in a portfolio, and each individual investor is unique, but bonds are really good for their diversification benefits, and that's really rooted in the math of how the markets work. Historically, bonds have had a low or negative correlation with stocks. And we can usually see this during periods of economic stress. So as soon as some sort of economic shock happens, we usually see if there is some sort of recession or something deeper, rates can decline almost immediately. We've seen emergency rate cuts happen before, and that causes bond prices to rise. But at the same time, if it's a severe economic shock or a recession, that causes usually equities react by selling off. And so that creates that negative correlation between the two. And so if an investor has both bonds and stocks, that means that the bond component can really help to prop up an investment portfolio during those basically tail risk type events. And so bonds can really work for crisis management. And because of that, low volatility ETFs can help to reduce equity volatility if they are included, but they generally don't provide the same diversification benefit that bonds do. On the other hand, for those individuals that want to seek out low volatility ETFs instead of bonds, they generally will have higher upside potential than bonds. And so investors that are comfortable with 100% equity exposure and also the potential for a larger and more correlated drawdown in the event of some sort of economic or market shock, using low volatility ETFs actually can work here.
Neil, did you have any thoughts on this one?
Yeah, Chris, you mentioned a lot of great points. Again, just from know your risk profile. If you need bonds for the stability, you need bonds for stability. Or if you have a shorter time horizon, if you're looking at a low volatility ETF, you're going to be adding equity market risk to your portfolio. So the risk profile will change. I pulled up here on my screen using the BMO ETFs compare tool, which is available to all investors online. I pulled up some standard deviation numbers to give you a sense of what does that low volatility actually mean. So standard deviation is a great metric if you're doing your due diligence at home as a retail investor to see how volatile that ETF is. And you can kind of gauge then, does it fit with your risk profile or does it fit with that risk tolerance? Can you stomach swings of certain degrees? So what a standard deviation tells you is how far from the mean and average return will the price swing. And it will swing either up or down. This is what this number tells you. So the broad Canadian equity market, and I'm using ZCN, the BMO S&P TSX Composite ETF as a proxy for that. The 3-year standard deviation is about 11%. If you look at ZLB, the Canadian low volatility ETF from BMO, you're looking at a standard deviation at about 8.6%. So about 3% lower price swings over that 3-year period. If you look at ZAG, the BMO Aggregate Bond ETF, which is fixed income, your standard deviation is 5%. So you'd see a 5% price swing over those 3 years. It's kind of a good way to look at things when you're analyzing ETFs and trying to determine if something is right for you.
Awesome. Thank you. And yeah, I will mention that I've mentioned the ETF comparison tool a bunch of times on the show. One thing that's neat about it is, despite Danielle being from BMO, you can put other ETFs in there as well. They don't have to just be BMO ETFs. So it's actually a really good kind of go-to tool where you can just put in any ETFs you want and compare them. So yeah, definitely recommend checking it out. It's free to use. You don't even have to sign up or anything like that. It's just a really, really good resource to compare ETFs. So that's wonderful. So yes, thank you so much to both of you for coming on and for making this issue of Canadian Money Saver magazine available for free to Build Wealth Canada listeners as well. So that's really awesome. Thank you for doing that. The link that everyone can go to get this issue for free, it's over at buildwealthcanada.ca/magazine. So just buildwealthcanada.ca/magazine. And there you'll be able to actually download the whole issue. Usually it's like a paid magazine that you have to subscribe to. But so thank you guys for making it, for being generous and giving that to everyone. And Danielle, where can we learn more from you and the team?
Bivo.com/ETFs. You can find that compare tool there, and you can research all our ETFs. There's an education center as well. It's a great resource.
Awesome. Thanks so much. And I'll be sure to link out to the comparison tool and all the other links as well. So thank you for that. And Chris, thanks so much for coming on as well, of course, and sharing your expertise. Of course, we can see more of your work at Canadian Money Saver Magazine, but where else can listeners go to learn from you?
Yeah, for sure. This was great. Thanks for having me on. So yeah, as you mentioned, I write for the Canadian Money Saver Magazine. But listeners can also find me at our investment research platform, 5i Research. That's where we answer member questions, investment questions, and we write research reports. And we also have an ETF newsletter service called the ETF Update, which can be found at etffundupdate.ca.
Awesome. Thanks so much. So yeah, I'll be sure to link out to that as well in the show notes. And yeah, thanks again for coming on, sharing your expertise. And yeah, congratulations on the issue of the magazine. I've already started reading it. It's been great. So thank you.
Thanks, Cornell. It's great to be here.
Yeah. Appreciate it. Thanks, Cornell.
You're welcome. Take care. Bye. All right. I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.